Hi there, this is Tencent. Today we'll be talking about a Chinese technology company that have seen a lot of news surrounding the company. The company decides to purchase shares in the company to reduce the number of shares in the company. This is great for the company and the stock market as it lowers the stock price of growth stocks in the stock market. The company they're talking about is Tencent Music. So in this video, we'll be talking about the reason why Tencent want to purchase shares of its own stock. Before we continue, please smash the like button, and if you'd like to see more such videos, please subscribe to this channel. Firstly, we'll be talking about the business model of the company. Tencent Music is a company that develops music streaming service for the Chinese market. This is a joint venture between Tencent and Spotify. Their apps include QQ Music, Quago, Kuwu, WeSing, and Ultimate Music, which has more than 800 million active users and 120 million paying subscribers. As of July 2016, Tencent Music 3 service held an estimated 56% market share of music streaming service in China. So if investors believe that Tencent Music could continue to maintain its market share in China, this stock will continue to rise in the future. Secondly, we'll be talking about how China listed stocks then fears of multiple disputes with the US. A new SEC rule that will require foreign companies to submit documentation about government affiliation and government influence is causing headache for China investors. It is one of several snakes that is popping up between US and Chinese investors. China stocks have been in a correction mode for several weeks, but the new rule is exacerbating the route, particularly those with listing in the US. While the new SEC rules apply to all foreign listed companies, they are specifically aiming at China, which has been repeatedly run afoul of efforts by US regulators to monitor the audits of Chinese companies. Finally, we'll be talking about the $1 billion share buyback program of Tencent Music. Tencent Music Entertainment Group announced plans to buy back up to $1 billion worth of shares after the US listed stock suffered a huge drop. The repurchase will start on last Monday and will take place over the next 12 months. Tencent Music is the online music arm of Chinese technology company Tencent, which runs streaming service and apps. The company, which is listed on the New York Stock Exchange, lost about a third of its value last week amidst a sell-off in Chinese technology stocks. Part of that selling came after the US SEC adopts a law that could lead to the delisting of foreign firms that fall foul of the new auditing rules. But further pressure came on last Friday after a capital management company was forced to liquidate positions it held in some major China technology names, which is reported by CNBC. So when the company started to repurchase its own stock, this means that the management team feel the stock is currently too cheap. In conclusion, Tencent Music drop recently in the US market is due to the margin call and not the fundamentals of the company. So if you still believe that the company will do well in the future, you should take this chance and purchase shares in the company when the stock market is busy selling the stock. Thank you, have a nice day. Goodbye.